What are examples of off-balance sheet financing? Have you ever wondered how some companies manage to look financially stronger than they really are? One way they do this is through off-balance sheet financing. This method allows businesses to keep certain assets and liabilities off their balance sheets, which can improve their financial ratios. Let's take a closer look at some common examples of off-balance sheet financing and how they work. First up, we have operating leases. In an operating lease, a company rents assets like equipment or real estate instead of buying them. The beauty of this arrangement is that the leased asset and the associated liability do not show up on the balance sheet. Instead, the company records the lease payments as operating expenses on the income statement. This helps companies avoid showing large liabilities, which can make their financial position appear stronger. Next, let's talk about special purpose entities. These are separate legal entities created by a company to hold certain assets and liabilities. By transferring these items to a special purpose entity, the parent company can keep those liabilities off its balance sheet. This is often done to isolate financial risk or to finance specific projects without affecting the parent company's credit metrics. However, companies must be careful to follow accounting rules to avoid misleading financial statements. Another example is factoring receivables. In this process, a company sells its accounts receivable to a third party, known as a factor, at a discount. This gives the company immediate cash while shifting the responsibility for collecting those receivables to the factor. Since the company no longer holds the receivables, it does not record a liability, which can improve liquidity and reduce credit risk on the balance sheet. Joint ventures are also a form of off-balance sheet financing. In a joint venture, two or more companies collaborate on a project, sharing resources and risks. The liabilities of the joint venture typically do not appear on the balance sheets of the parent companies if the joint venture is not consolidated. This allows companies to pursue new business opportunities without increasing their reported debt. Lastly, we have sale and leaseback arrangements. In this scenario, a company sells an asset and immediately leases it back from the buyer. This removes the asset from the balance sheet, providing immediate capital, while the lease payments are recorded as operating expenses. This can improve liquidity and financial ratios by converting owned assets into off-balance sheet leased assets. There are also other off-balance sheet items, such as letters of credit and loan commitments. While these do not appear as liabilities on the balance sheet, companies must disclose them in financial statement footnotes if they could significantly impact their financial position. Understanding off-balance sheet financing is important for anyone involved in financial statements education and financial statement analysis education. While these methods can help companies manage their financial presentation, they must also ensure transparency through proper disclosure.